Thanks for joining me today. Let's talk about what's been going on in the markets this year and some tips on how we can deal with what's happening. So we're going to start with, I'm going to share my screen here, and I am going to pull up some of my favorite slides for everyone to look at. Okay, so you can see there that that is myself and Preet and it's my professional designations. Okay, so we're going to start with what's been going on. So it's been a really challenging year this year for investors, and it's quite natural for investors to be worried about the long-term impact on your investments and how this affects people's ability to retire and retire well. So we're going to talk a little bit about what's gone on this year and what you can do. Most well-balanced, diversified portfolios are down year to date, even at this point on the 1st of December. But I will talk a little bit about what happened last month. November was a much better month. And although everything is still down year to date, we have had November was pretty positive month, and that will positively impact your portfolios. So then I'm going to just pull up this agenda here. I've got some graphs and some index here. The first one I want to show you is the S&P 500. So you probably hear that term bantered about if you listen to any business news. And the S&P 500 is a stock market index that tracks the stock performance of approximately 500 of the largest companies in the US, and it's one of the more commonly followed indexes. So year to date, the S&P 500 is in fact down 14.49%. So year to date means as of the 1st of January 2022, and as of close last night, it's down 14.49%. However, last month, just that month alone in November, it rebounded 5.25%. So before the month of November, it was down almost 20%, and now we're down minus 14. So we're moving in the right direction. The next one I have up here is the Dow Jones Industrial Average. Again, this is another one that you hear talked about, the Dow being up, the Dow being down today. And this is a stock market, and it's got 30 of the most prominent, largest companies on the stock exchange in the US. And it is one of the oldest and most commonly followed. So Walmart, Johnson & Johnson, Coca-Cola, Disney, those are all large US companies that would be on the Dow Jones Industrial Average. And this also is down year to date. So as of the 1st of January 2022, up until now, it's off about 5.63% year to date. Last month, it returned positive territory of 4.77. So again, November was a pretty positive month for most indexes, and this will have a positive impact on when you look at the bottom line of your investment statements. Next one we have up here is the NASDAQ. So the NASDAQ is it's an entire NASDAQ stock market, and it's got a higher concentration of smaller technology companies. So it tends to be an indication of how the technology sector is doing in the US. So the NASDAQ is down substantially year to date, minus 26.73 year to date, which is still pretty substantial. Again, had a good month last month. It's up 4.33 just last month alone, but still it's down substantially. So that's your tech sector. And the S&P TSX, that's a composite index, and that is what we commonly refer to as, the Canadian representative of the Canadian index. The TSX S&P composite index, it represents 70% of the total market capitalization on the Canadian TSX Toronto Stock Exchange. And we were at an all-time high of 21,000 on November the 12th, 2021. And we're moving back in that direction. Again, the S&P TSX is down 3.2% year to date. And last month it had a positive return of 5.71. So again, November was a pretty good month for all indexes, or most anyway. And the last one I'm going to pull up here is the MSCI World Index. So this is a global index, and the MSCI World Index that tracks 23 of the developed markets, and got a list there of all the countries that are included in that index. Canada obviously is included, also the US, but you can see a lot of other developed countries are in there as well too. There's also the MSI Emerging Markets Index, which covers the emerging markets, and that's another index that you hear talked about a lot. Okay, so let's get on to some graphs. So this is one of my favorite graphs, and what it shows, it's trying to show here is that on the right-hand side, you can see 7 different instances over the last 50 years where the stock market is down in excess of 20%. And what generally happens is when the equity market is down such a great deal, 20%, it's your bond market that holds things together. So if you look at October 2007 to March 2009, again, that's the 2008-2009 financial global crisis. Equities were down minus 56.8%, but your bonds were up 15.4%. So if you've got a well-diversified, balanced portfolio, you know, when your stocks are off, your bonds are holding things together. And again, you've got some other examples here from different years. February 2020 to March, that's when the pandemic started. Equities were off 33.9, and your bond was holding things together with positive return of 5.1. That's not happened in 2022. This is the first year since I'm aware of where you've got both equity and the stock market. The equity, stock market, and also your bond market are both off substantially. So you can see down here at the bottom, January 2022 to May 2022, just even in that 5-month period of time, your equities are down 14% and your bonds are also down -8. So that's substantial. That is creating a horrible situation for 2022. Okay, and here's just a few examples of market crises in the past, 70 years, and what has happened a year later and how long it's taken to recover. So Cuban Missile Crisis, down 26%. You've got 10 months to recover. What the return is like a year later and 2 years later. And then some of the more ugly ones, which is the subprime mortgage crisis, March 9th, 2009. That was the lowest point. Markets were off -56.8%. Took 47 months for that recovery to get itself turned around. But you can see there a year later and 2 years later what those returns look like. So market corrections and market crisis, it is part of investing. It's part of long-term investing. This is showing a graph what $100,000 would have grown to if you'd instead invested and started investing since 1977, what that would look like. And it's pretty substantial, of course, if you had been invested that length of time. But what it does also show here is the corrections and how long some of these corrections it takes to turn around. So September 2000 to September 2002, it took 2 full years to get down to that -45%. And then to recover from that was another few years after that. And to get beyond that was, again, another period of time. So the best strategy to invest well is to invest long-term, stay invested, and just work through this volatility and just don't jump out of the markets. No one can time the market. It's impossible to know when some of your best and your worst trading days are. What generally happens, some of the worst trading days are clustered around some of the best trading days. So when you hear that the markets are off 3 and 4% in a day, and that you have this urge to jump out, you're potentially missing out some of the best recovery days. So again, 2008, 2009 is a great example of all those clustering of some of those horrible days in the markets, and some of the best days are all kind of clustered together there. This is what happens if you miss some of the best days. Again, timing the market is difficult and challenging to do. If you had invested $100,000 over the last 30 years and you've instead invested over those 30 years, your $100,000 would be worth over $2 million, and you would have averaged 10.6%. And this is the S&P 500. If you miss some of those best days, even down here, just missing 10 of the best days, we're talking about 10 of the best days over that full 30-year period, your 10.6 drops down to 7.8, not nearly as attractive return. So no one can tell you when the best and the worst days, and it's really hard to try and time the market. The best thing to do is just build an investment plan that works with your time horizon and risk tolerance, and stay invested. This shows what happens if you jump out of the market, even for a short period of time. So we've got this blue line here, dark blue line shows what $100,000 invested would look like if you had invested in 2007 up until 2021. So $100,000 over that time frame would be worth $456,000. Now, if you'd panicked in 2008 and 2009 and moved out of the markets and just stayed in cash for a period of time and jumped back into the markets when things seem to have calmed down, this dotted blue line shows you what that looks like. And I think that's at about 265,000. So that's a pretty substantial difference. That's 191,000 difference by just staying out of the market for a year. And the orange gold line is the Canadian markets, and same thing, looking at the difference between staying invested and getting out of the market at the worst time and staying out for just a year. This is the case for diversification. This is showing all the different sectors. So you've got Canadian large cap, Canadian smaller companies, US large cap, US smaller companies, international emerging markets, global real estate, fixed income, all the different sectors. And what you want to ensure that you have in your portfolio is that you're diversified. You don't want to have all your eggs in one basket. You don't want to have just one particular asset. You want to be diversified and make sure you've got all of these things in your investing basket, because you can see that what does well in 1 year, 2011, 9.7 is your Canadian fixed income. And then the next year, that is one of the least attractive markets to be in. So it's really important to be diversified and have a little bit of everything in your investment portfolio. This just shows, trying to illustrate that downside volatility is normal. You can see there, the dark blue graphs are showing year-to-date returns, and the red, the negative, the red are showing years where you've got a negative rate of return. And just trying to indicate here that during the course of the year, these little blue dots are periods of time where during the course of the year where you've actually got a negative return partway through the year. Okay, so what are some strategies? So the first thing, I think, is that it's nice to have a little bit of an understanding of what goes on in the markets, and that this is normal, and that you just feel a little bit more educated and feel a little bit better about what's going on in the market. That's probably one of the most effective ways to deal with market volatility. The other very important strategy, of course, is to work with a professional. There's lots of research that shows that Canadians and investors working with a financial professional they accumulate more assets, they get better advice, the more their wealth grows. And you've got a partner, you've got someone that you can talk to about what's happening in the markets, about what's happening with their financial future. A financial planner is going to do a lot of different things for you, but they will help you determine what your goals are and what your investment time horizon should look like, and what your risk profile and tolerance should look like, and keep you focused, review your progress, and just keep you moving in the right direction. The other thing that is a great tip is to take a look at getting your financial plan updated. If you've never had a financial plan, or if you've had one in the past, now is a good time to actually get that updated with these new values, with these lower market values for your RSPs and your tax-frees and your investments, because you can have a financial plan prepared and just take a look at what things are going to look like for you in 5 years, 10 years, 25 years time. It's getting that updated and looking at the overall long term helps making sure that you feel better about where you are with your financial future. And make sure you're diversified. And okay, so last little slide here. And thank you for joining me today. If you have questions or concerns, please feel free to reach out to me. Pam Mundell at asante.com. Thanks for joining me today.